Welcome. In this session, we'll take a closer look at how credit works, what debt really means, and strategies to borrow responsibly. By the end, you'll see that credit isn't something to fear, it's a tool. But like any tool, it needs to be used carefully. Credit is borrowed money that you agree to repay later, often with interest. When you use a credit card, take out a loan, or finance a purchase, you're using credit. Lenders extend credit based on trust that you'll repay them. This trust is built over time, and your track record becomes your credit history. For students, credit often starts with something small, like a student credit card or a loan for tuition. These early experiences shape your financial reputation for years to come. Debt is the balance you owe when you use credit and don't pay it back immediately. For example, if you charge $200 on a credit card and only pay $50, the remaining $150 becomes debt. On top of that, interest is added, which can make the debt grow if you don't pay it down quickly. Debt itself isn't always bad. Student loans, mortgages, or car loans can be considered productive debt if they help you reach long-term goals. But high-interest credit card debt or payday loans can quickly spiral into financial problems. Credit is more than just borrowing money. It's about your financial reputation. Every time you make a payment on a loan or a credit card, that record gets reported to credit bureaus. These records are used to calculate your credit score, a number that shows lenders how trustworthy you are with money. Why does this matter to students? Your credit score can affect your ability to rent an apartment, buy a car, qualify for a mortgage, or even get certain jobs. A strong credit history can open doors, while poor credit can mean higher costs, more fees, or being denied altogether. Think of credit as your financial GPA. It tells others how well you manage your money over time. When you borrow money, the true cost isn't just the amount you borrow, it's the interest and fees you pay until it's repaid. For example, if you carry $1,000 of credit card debt with a 20% interest rate and you only make minimum payments, it could take years to pay off and cost you hundreds of dollars in interest. This is why debt can feel overwhelming. What starts as a small balance can quickly grow into something much larger if it isn't managed carefully. So how can you use credit responsibly? First, only borrow what you can realistically repay. Just because you're approved for a $2,000 credit limit doesn't mean you should spend it all. Second, pay on time, every time. Even one late payment can hurt your credit score and add late fees. Setting up reminders or automatic payments can make this easier. Third, pay more than the minimum. Minimum payments keep your account in good standing, but they don't reduce your debt quickly. Paying even a little extra each month saves you money in the long run. Finally, compare loan offers, avoid predatory lenders, and read the fine print. Understanding the terms helps you avoid surprises. Let's imagine two students, Alex and Jordan. Alex uses a credit card for emergencies only and pays it off each month. Jordan uses a card for daily spending, pays only the minimum, and builds up a $1,500 balance. After a year, Alex has no debt and a growing credit score, while Jordan owes even more due to interest. This example shows how everyday choices create very different financial futures. To wrap up, credit is a tool and debt is the cost of using it. Both can work for you or against you. By borrowing smartly, paying on time, and keeping balances low, you'll use credit to build opportunities instead of barriers. This concludes our discussion about credit and debt. In the next lesson, we will learn about credit cards, loans, and student loans. See you then.